Welcome to Lesson 16, Chart Basics Lesson 2. Today we learn time frames. The same Bitcoin looks like a 6-month or 1-year trend on a monthly chart, and like dozens of tiny wiggles on a 1-minute chart. What we'll cover: 1. What a time frame means. 2. Monthly versus weekly versus daily. 3. Higher time frames equals direction, lower time frames equals entry timing. 4. How to read several time frames together. The classic beginner trap is staring only at 1-minute and 5-minute charts and missing the multi-week trend, the same way people watch every tick of the Nasdaq and forget the S&P 500's bigger arc. Today you'll learn how to dodge that trap early. Look at the daily chart on your screen. Each candle holds one full day's price action. Drop a comment and tell me, which time frame do you use most right now? A time frame is how much time one candle packs. A monthly candle holds about 1 month, a weekly candle 1 week, a daily candle 1 day. Minute charts use minute-sized candles. On screen we're looking at the monthly chart, and I'll walk the monthly idea with you. On a monthly chart, one candle holds roughly a month of price, so 3 years of data compress into about 36 candles. That's the biggest picture view. The same Bitcoin looks completely different when you change the time frame. Monthly shows the last year's trend at a glance. A 1-minute chart shows hundreds of tiny swings and gets noisy fast. The same gap you'd feel between an S&P 500 monthly chart and a scalp of the open. There is no single correct time frame. You pick by goal. Multi-month investing leans monthly, day trading leans minutes. On bigger time frames like monthly, major uptrends and downtrends stand out clearly, so you stop missing the forest for the trees. Now we're on the weekly chart, one step down from monthly. The big story is still clear, but you see a little more detail in the moves. Here's the core rule. The higher time frame sets the big direction. If this weekly chart is in an uptrend, the big flow is up. Often a daily or 1-hour chart can look like it's falling, yet if weekly and monthly are clearly rising, that pullback is usually temporary, like a company posting a strong quarter while your checking account looks thin the day before payday, or like the S&P 500 holding its year trend while one Fed week session dumps a few percent. So before you trade, make it a habit to check the higher time frame first. Ask, where is the big flow headed? And you won't get fooled by every small wave. Look at the weekly chart on screen. Is the last 3 to 6 month trend up or down? Now, the daily chart. Each candle here is 1 day's move. You already locked the big direction on weekly and monthly, so daily is for deciding which day to enter. Multi-timeframe core rule. Higher time frame equals big direction. Lower time frame equals entry timing. Example: if the weekly is trending up about 5%, a 2 to 3% dip on the daily is often a better entry window. The same idea swing traders use on Apple or the VASA when the weekly trend is intact. Ignore the big flow and trade only the daily, and big losses get easier. You sell because yesterday dropped 2%, so tomorrow will too. But if the weekly is still strongly rising, you just traded against the real trend. So the analysis order is fixed. First, confirm direction on the higher time frame, monthly/weekly. Next, recheck that direction on the middle time frame, daily. Last, time the entry on a lower time frame. Traders call this narrowing in from the big picture down to the small timing. It's a basic habit of professionals. In practice, most people watch 3 time frames together. That's multi-timeframe analysis. 이그잼플 스택, 위클리, 빅 디렉션, 그러면 데일리, 트렌드 책, 그러면 4-5, 엔트리 시그널. The 4-hour chart on screen uses 4-hour candles. It catches moves faster than daily. The key: trust is highest only when it points the same way as weekly and daily. When all three point up, that's a strong alignment. If weekly is up but daily is down, and the 4-hour is soft, the picture is unclear, sitting out is safer.
It first, practice only monthly 그러면 weekly 그러면 daily.
Add minute charts after you have experience. Too many frames and the signals stack into noise. The same overload you'd get flipping between every S&P 500 and AG interval at once. There is no single correct combo. Match it to your style. Multi-month investing, swing trading, or day trading. The most common beginner mistake, living on 1-minute and 5-minute charts only. Stare at minutes for hours, and you completely miss the multi-week trend. Lower time frames are packed with noise, meaningless chatter, and tiny swings. Leaves can shake all day while the tree still leans the same way. Obsess over ripples, and you miss the wave, like stressing over a $3 coffee price tick while your monthly grocery bill and rent tell the real story. Another trap. Every time frame can show a different signal. Weekly up, daily down? Follow the rule, higher time frame wins, and you avoid the confusion. Ignore the higher time frame and live only on the small one, and you end up trading against the real flow. Losses add up. Starting from the monthly chart feels tedious at first. Later it becomes the shield that keeps you from taking the big hit. Lesson 16 wrap-up. First, a time frame is the time unit one candle holds, monthly, weekly, daily, all the way down to minutes. Second, higher time frames decide the big direction. Lower time frames give entry timing. Always start with the big picture. Third, multi-time frame usually means combining 3 charts, for example, weekly, direction, 그러면 daily, confirm, 그러면 4-hour, signal, narrowing in. Next lesson, we cover volume, how many participants were active when the chart moved, and how that helps you check whether a trend is trustworthy on Bitcoin, the S&P 500, or the NASA-like. If this helped, hit subscribe and like. Questions or takes? Leave a comment. This lesson is for education only. It is not investment advice.